what we have on this episode of The Money Show. First up, we'll be talking to Tarun Birani of TBNG Capital. This as we talk about investing in equities, managing your equity mutual fund portfolio, asset allocation, rebalancing as well. All of this amid this massive market rally that we are witnessing, which took the Sensex as well to the 50,000 mark on Thursday. What should you do? Is there any action warranted for retail long-term equity mutual investors? We will be talking to Tarun Birani on these topics. And of course, let's not forget, you can always connect with us by writing in on The Money Show at etnow.tv. We are constantly checking our email address. So any question or query that you send in, we'll try and take it up with Tarun right away or in the following episodes of The Money Show. Later on the show, we'll be talking about motor vehicle insurance. Guess what? There's a working committee currently working on how any traffic violation committed by you will be used to jack up your premium. So ladies and gentlemen, drive with care, follow all traffic rules. If you don't, you'll end up shelling more from your pocket to get your car insured. But how will these rules work? Well, we'll be talking to Naval Goyal of Policy X on the very same topic. But first up, let's address our first topic at hand, and that is this significant market rally. Equities have definitely been a great asset class to invest in. In fact, if you had been a little bold last year, taken on a few risky bets, you would have actually made a lot of money in equities, whether it's in mutual funds, whether it's in individual stocks as well. That's the kind of rally that we have seen in equities, in the last year. In fact, risky assets itself have, really exceeded all expectations with the rally that we have seen. So, what should a retail investor do in such a scenario? I mean, it could be sometimes tempting to just take some money off the table, enjoy some of the profits over there. But for long-term investors, do you think you should sort of stay put? So let's welcome now on the show Tarun Birani. Hi Tarun, a very good evening and thank you so much for joining us today on ET Now. To start with, as an investor, as a wealth manager, as a personal finance advisor for so many years, you've obviously, this is not the first milestone you've experienced the Indian equity markets touch, and I bet it's not going to be the last either. Let's first understand, how have you seen equity markets help create wealth for the average Indian?
So, good evening, Mubina, and thank you for having me here. So, what a journey it has been with a benchmark index which was at 100 in 1979 when I was actually born, to 50,000 mark as we talk in January 2021. And to my mind, this is one of the biggest wealth creation story with a compounded annual growth rate of almost 15.5% over a span of 43 years. No doubt this journey has its own ups and downs, where we have seen the Sensex reaching 25,000 also this year in the March. So it is not for the light-hearted. This is for somebody who have the patience and the grit to make money over a long period of time. One more big observation I have seen is investment and investor returns are always different. I have seen investments have given 15-16% return, but when you talk to investor, their returns are less than say 10-11%. So this gap of 5-6% is nothing but because of the behavior. So to my mind, investments are giving, and to my equity is giving, or the Indian markets are giving phenomenal return. But we have to make sure investor actually make this money. That is the point we have to work on. Mubina?
Okay, and we'll sort of take that point as well forward with you, Tarun, and I'm sure many of our viewers as well have this standard question about, okay, what should I do now? The market has rallied, or sometimes, in fact, another very common question that we are asked is that, okay, I'm seeing the market rally, but when I look back at my own portfolio, I don't feel like it has done a lot. And I think that's a very valid point as well. But let's start off first with this point. Do you think there will always be room for wealth creation, for long-term investors? Why do you think they should stay put?
So the year gone by has given us a strong reminder of the importance of a financial plan. And to summarize, money success is a single word called survival. I feel capitalism is hard, but part of the reason it's making money and keeping money requires a very different skill set. I wonder how making money requires taking risk, but being optimistic, but wealth planning or saving requires the opposite. It requires one to be humble as well as realistic. So more than 2,000 books are dedicated to Warren Buffett, and Warren Buffett is worth, as we speak, almost $85 billion. But he made his at his age 50, he made his $60 billion, and at his age 60, he made $81 billion. So you can understand the magic lies in compounding. The more you stay on, that's where you make money. So the magic is compounding as well as asset allocation. According to me, is defining your risk tolerance and your financial goals, and accordingly plan your investments. And this puzzle of when to get out, when to get in can be solved much more easily at that point of time. I understand markets are up, but at this point of time, you have to define your own formula if you have not defined. So let's say I'll talk about myself. I have defined a 50-50 formula or a 70-30 formula for myself. Whenever I see this formula moving about to, let's say, 75 or 80, I quickly sell and come back to 70 level. And according to me, this helps me navigate this volatility much better rather than getting into that noise discussion all the time. What to do? Markets are up, down, and everything. Yes.
Yeah, absolutely. And I think, one should sort of start off with asset allocation, decide what are you investing for, and then, perhaps just stick to that. However, Tarun, sometimes, and we have noticed this, we have the AMFI data as well, that has indicated that especially in these last 4-5 months where the market rally has really caught up speed, we've seen equity mutual fund investors pull out. There have been net outflows, month after month for some time. So how would you explain that? And I was seeing some reports, yes, the reason why, one of the reasons behind it is also because, there's this cash crunch because of COVID. So yes, okay, that's understandable. But then many have also been scared of this market volatility. So what is the right approach then really over here?
So, as I discussed, asset allocation is the only approach which can help investors should always do something which is in their control, not outside their control. So, rebalancing is one of the process of realigning the weightage of the portfolio of the assets. So, it involves periodically buying and selling assets in a portfolio to maintain an original or desired level of asset allocation. For example, you started at an asset allocation of 50 stocks and 50 bond. If the stock performed well during that period, it could have increased the stock weightage, and you need to get them out to the old level of 50-50. So it helps in safeguarding the investor from overly exposed to a single asset class. And I would strongly recommend in this current scenario. So you were talking about the AMFI data, Mubina. To my mind, we are at 30 lakh crores of asset under management in mutual fund as we speak, and out of that between 10 to 12 lakh crores is with equity or the hybrid mutual fund. Out of this 10 to 12 lakh crores, even if at 35,000 crores have come out, I would not read much into it. It would be a basic profit booking which is happening, and this is a healthy sign that investors are doing that profit booking at this higher level.
All right, understood. So, yes, like you mentioned, it's perhaps a little bit of profit booking that we are seeing a lot of investors, indulge in. Tarun, how can investors take advantage of this rally to even consider rebalancing their portfolio?
also that rebalancing is a process where you need to be very disciplined about the periodicity of that. One can look at a quarterly rebalancing, annual rebalancing, 6 monthly rebalancing. Once you have defined that, you have to make sure that you are following it with a complete discipline. So at this point of time, let's say 50 is my desired level. And if I've gone to 60, please go ahead and get out that 10 from your system. And this will make sure that you will maintain that original level of 50-50. So this will help you sell at a higher level. And whenever the, let's say, market goes down and this 50-50 moves to 40, you will be able to add 10 more and that will again get you back to the 50 level. So according to me, magic lies there, nothing else.
Okay, it's a very simple methodology, really. Tarun, now what would you say to those individuals who look at the market and they see, okay, wow, we're at record highs. Sensex is hitting 50,000, and the Nifty, is going to soon approach 15,000 itself. So, but I don't see my mutual funds giving such returns. So, what would you say to such individuals?
My only advice would be stop getting in that noise stuff. Don't get in that 15,000, 20,000 point, and rather you better get your acts together in defining what works for you, what is your plan, when do you need the money. I think that is what one can do rather than getting into this endless topic of what the index levels are. So the magic lies there only, nothing else.
Okay. But still, Tarun, sometimes would this also be a telltale sign that maybe you should, shuffle your portfolio a little bit, that, okay, this one's not been performing for a very long time, so maybe move to another fund in the same category, or do you think that that should be completely ignored?
I think there is a science behind that. There are a lot of qualitative and quantitative parameters one can look at. Whatever investments they have done, we need to get deeper into those qualitative as well as quantitative aspects. Whenever we see these markers getting worse, I think one should definitely get his portfolio rebalanced to a better ones. So yes, definitely one can use this current rally to actually rebalance their portfolio into better portfolio.
We were in conversation with Tarun Birani talking about this massive market rally that we have witnessed, and as equity mutual fund holders, what should you do? I mean, should you just adopt patience? Is there more room for wealth creation, especially for long-term investors? Well, Tarun's answer is yes. Stay true to your initial objective of behind investing, to your asset allocation strategy as well, and there won't be much of a space essentially to go wrong. Okay, let's take on board some questions and queries that we've received from our viewers. Remember, folks, if you'd like to connect with us, you can write in on themoneyshow@etnow.tv. We'll take up your question right away. So let's take on board our first question. Chetan Shetty writes in saying, how many mutual funds are ideal for a long-term portfolio of, say, the next 5 years? Secondly, what should be the percent to buy in various fund categories? So I presume he means large caps, mid caps, small caps, multi caps, and I'd like to throw in over your debt funds as well, because they too are a crucial part of one's portfolio. He also adds that I'm ready to take a certain amount of risk, and he also has accumulated a total corpus of 50 lakh rupees in lump sum. So he's ready with the money. He just is waiting on a good strategy to help him deploy it. So his question seems to be, how many mutual funds in a portfolio? And Tarun, many a times we get portfolios in our question segment, and we see it's filled with 9-10 portfolios, and more often than not, most of these portfolios have overlapping stocks. So this is a very crucial question, Tarun. How would you like to address it?
Yeah. So Mubina, I feel small is beautiful, and whenever there is a small set of funds in your portfolio, it brings in simplicity. And when there is a simplicity, there is a proper review mechanism which can be put in force. But let's address Chetan's specific challenge that first Chetan need to very clearly define his clear-cut financial goals, as well as he need to define his risk tolerance. And I'm assuming, let's say his risk tolerance is between 50-50. My quick suggestion would be for an allocation into 35% of his money should go into debt mutual funds. 30% should go into a category called dynamic asset allocation, and 35% should go into equity funds. Again, coming to in equity funds, he can further divide it in between 30% in large cap funds, and there primarily my advice would be to go more for index based Nifty as well as Nifty Next 50 index funds, because that's where I see better alpha creation compared to normal large cap funds. 30% can be allocated to multi-cap fund, where you can see funds with a mix of large and mid cap as well as some global allocation also. Mid and small cap can have 30%, because I feel going forward relative valuation in mid and small caps are much better. So a 30% allocation can help him get better alpha. And from a tactical point of view, I feel sectoral funds like banking category is poised for a better growth in going 5 years. So he can look at 10% allocation there. And I feel not more than one or two funds in each category should be selected.
All right. So that's how Tarun essentially recommends one can start off. Of course, it always helps when you mention what your investment goal is or why you want to put your money. I'm assuming more often than not, it's usually for these individuals who want to ensure that they're able to generate a good amount of return, perhaps for wealth creation, for retirement. But yeah, it's always better to have stated goals, so it's always easier for the financial advisor as well to guide you accordingly. And don't forget, it's always better to consult with a financial advisor as well. Okay, let's take the next query. This is a very interesting one. ET Wealth had an article saying that there will be a correction of 8 to 10%. What should be my strategy? I have a portfolio of 3 large cap funds, 1 mid cap and 1 small cap fund that I started investing for my retirement in 2045. I started these in 2017, so just 4 years ago. This is well, he's read an article and it says that there is a possibility of a correction. Tarun, should that change somebody's strategy? Should that cause a long-term investor like Santu Mohandal to take stand up, pay attention, and sort of make calls to his financial advisor to change anything?
So on a lighter note, Mubina, nobody knows what is going to happen tomorrow. And I have a very simple example, which I know in our last test match in Australia, everybody has written off India. And we have seen Indian B team has conquered the best Australian team. So I don't believe in all these noise that, and nobody knows what is going to happen. So let's not get into that debate, markets are going to correct or not. And again, my suggestion would be do what is in your control, and what is in your control is define your asset allocation, define your goals, and the magic lies in patience and temperament. Your investing behavior need to be correct. When there was a 30% correction in the market in March, how many of us were able to add in the portfolio? I think that is a question we need to ask. And Santu is saying that 8 to 10% drawdown. I feel if he is not able to take a 8 to 10% drawdown, he don't need to be in equities. He need to stay into fixed deposit, because that is not a space he should invest into. Okay. Again, very extreme views, but I feel that one need to be a high conviction investor and follow this asset allocation magic to get the money. I feel he has done the right thing by having large cap funds majorly in the portfolio and 2 mid and small cap funds for his retirement. Again, I'm surprised that if he has a outlook like 30 years on the portfolio, why is getting with a 8 to 10% drawdown and all that? So he should avoid getting into that. He should focus more on his work and business, and he should get his asset allocation based investing and goal based investing. That's my suggestion to him.
your goal, pardon me, is almost 25 years away. So it really shouldn't bother you if there's a 7-8% correction over the next 1-2 months. Just a course that the equity markets take. I mean, in this last 15 years itself, we've seen 2 big crashes in the market and a massive recovery from there. So frankly, when your goal is so far away, you have the benefit of time on your hands and you shouldn't be too perturbed. Okay, let's take on board our next question. Vijay Lakshmi writes in to us saying, I'm 45 and would like to get a corpus of 1 crore rupees for my retirement. Please check if my SIP portfolio is correct. I invest twice in a month. So there's 3,000 rupees per month in BOI AXA Tax Saver Fund. That's perhaps, to manage her ELSS and ATC deductions. There's a Parag Parag long-term equity fund, an extremely popular one recently, 4,000 rupees. Then there's a Motilal Nasdaq 100,000 rupees, Axis Midcap, Quant Small Cap, Kotak Gold Fund, all 1,000 rupees each in each of these. So what should be my total SIP amount to reach my goal? What would you recommend, Vijay Lakshmi?
So my quick observation that to reach a 1 crore goal in 15 years, she need to save minimum between 20 to 25,000 per month. And she is currently saving 11,000 rupees. So a 10 to 15,000 more addition on our portfolio can help her reach her goal comfortably with an expected growth rate of 10 to 12%. Her current allocation of 10% into gold, 20% into mid and small cap, 10% into global strategy, and 40%, 35% into a multi-cap fund like a Parag Parag looks good to me. And ELSS fund is where 25% of our money going. I can see one gap in our portfolio. I can't see any large cap fund. So maybe she can add one index fund in the portfolio for the incremental SIPs, what she's planning for. Thank you.
Well, on that note, we are now out of time. So thank you so much, Tarun, for joining us and, allowing us to extend our appointment with you for a little while on account of breaking news. And thank you. Appreciate you giving us your time.
Thank you, Mubina. Thank you so much.
On that note, we'll take a very short break. Don't go anywhere.